Hello and welcome to another episode of Finance Footnotes. Happy 2026 from your friendly co-host. I'm Brent Zach, and I'm joined by my friend and colleague, Zach Miner. And today we're going to take you through some of the happenings in the marketplace. It's already 2026. A lot happened last year. We're going to go through it and what the tea leaves say could happen here in 2026. So without any other ado, let's get started. As usual, I'll start by sharing a clipping here from the Wall Street Journal this very morning talking about where things are. And Zach, as you can see, as of yesterday, which is a great day for the market, first day of the year, second day of the trading year, I guess, markets within just an inch of all-time highs. And I think maybe even hitting it as we speak today. So things have continued to do very well in the U.S. equity markets. And I'll take a pause here on the next slide. This is just talking about 2025 returns from best to worst. And you may have heard some of the precious metals have done extremely well in 2025. Silver was up 142%. Everyone's going to sell grandma's silverware, Zach, at their local pawn shop. Gold up 64%. European stocks up 21%. NASDAQ 20, S&P 16. And then, a 60-40 blend up about 12.5, and then 40-60 more conservative clients up about 11. Bonds up 7. Some interesting thing, not everything was up. Oil was actually down 20% in the year. I think that kind of got lost in all the news feed there. But I think the best news of 2025, Zach, we can all agree, is that the chocolate prices came down by 48%. So hopefully
Those cocoa investors had a rough go.
they got murdered, but the rest of us can have cheaper chocolate and more expensive coffee. So I think that's a very exciting thing. So on the next slide, I want to highlight two of, I think, the most important investors of all time. Of course, we have Warren Buffett. Everyone knows that man on the top. His fund, Berkshire Hathaway, S&P 500 up 16%. Berkshire, most legendary investor of all time, probably up 10.9%. So it did lag the market meaningfully, And then, Zach, do you know the handsome gentleman there underneath Mr. Buffett?
That'd be Ken Griffin of Citadel.
Yes, sir. And I think most people would argue, or you could easily argue, that he's probably the most successful and sought after hedge fund manager, maybe of all time. But he's ultra successful. His fund actually lagged for the first time in a long time, up only 10%. The reason I mentioned this just to say that there was dispersion in stocks. The average stock was up about 10%, simple average. And there's, of course, an average, those big ones, the big tech names that you can think of. They did very well. But Zach, did I hear of the Magnificent Seven, only like two outperformed the S&P? Is that correct?
Yeah, and a couple of them significantly underperformed. It was definitely a broadening out year for the market, which I don't think people necessarily think of. I think it's the popular view is that the market is entirely driven by, those seven stocks, and it kind of really wasn't the case. And it was fairly broad participation.
Things have broadened out for sure. And all that to say, even some of the best minds in the business got maybe half a step behind this year. But we don't care about what happened last year. We want to talk about what's going to happen going forward. So turning to the next slide, that's what we're going to do. Every year, there's a traditional Wall Street where the investment banks sit together and laugh at each other and come up with their best guess as to what can happen in that year. It's really a fool's game. It's very difficult to come up with an estimate. But interestingly enough, 21 major Wall Street banks on average expect a 13% return in 2026 on the S&P 500, including dividends. I'm sorry, not including dividends. All 21 expected positive returns. I always think this is a bit of a, Zach can correct me if I'm wrong. This always puts my ear up a bit. I'm always a little concerned when everyone's on the same side of the ship.
Yep.
The market has a way of making people look foolish. So if everyone's expecting good things, always have an ear to the ground there. I think the expectations were somewhere between like 2% positive and maybe 20% thereabouts, but with an average of 13%. And of course, last year, same banks made the same prediction. They estimated about a 7% overall return. So I thought this would be a great time to segue to your friend Brent, who did have, I'm going to take a victory lap here, Zach. This is a clipping from our YouTube video just from last year when we were looking at the same tea leaves, trying to make prognostications. And you'll see there, this time last year, I said I thought there's an 80% chance that stocks would be up more than 12%. Nailed it. And I also said, very likely we're going to have a 10% or more correction. And the market was down about 20% from peak in April with all the tariff. So I'm not promising a similar accuracy score, but when you get it, you have to take a victory lap, Zach. So,
Fantastic. I love it.
All right. So let's just take a I am going to give you my best guess, which is just a guess, I promise you, as to what I think things will do here in 2026 for the S&P 500. And I want to give you three reasons why I think markets could go up. And the first is inflation. Zach, this has been to me one of the biggest surprises coming out of April, that inflation has been much less than expected. So the November read from the BLS, this is the government read, up 2.7% overall. It was much less than the 3.1% that was expected. Inflation is a variable that really dogs markets. No one likes it, but you see here the trend, this graph, it's down meaningfully since the peak in 2022.
It's
Another
pretty
gauge
amazing.
that
I mean, look, tariffs are pretty high, even with all the back and forth. And it's just really not finding its way into the CPI
Zach, hold on
numbers.
for two slides. I'm going to blow your mind, and so too the folks at home. Before I do, I want to talk about trueflation. Zach, you and I talk about this a lot. The
Yeah.
government data, take it or leave it. It's laborious. There's a new, with technology, trueflation. It's a free tool, real time, millions of data points. And as of yesterday, it expected inflation in the economy was at 1.95%. This is very low. This is very on track with Federal Reserve's goal
Mhm.
and has been more of a leading indicator. So I think we could expect, the BLS, the government official read, to come out a little bit lower going forward, Zach, to your point. The point I wanted to share with you that kind of blew my mind this morning. This is an article in the Wall Street Journal this very morning, and I have the citation in the bottom. But what it says, and I quote, economists at the Federal Reserve Bank of San Francisco combined data from 1886 to 2017, and they found, quote, previous tariff increase usually didn't lead to higher inflation. On the contrary, they slowed down price growth. Now, take a pause there. Go back to April, Zach. How many people were saying this on the news feed and the newspapers? I don't remember anyone saying this.
No, nobody.
So the
I
Federal
think the
Reserve,
consensus was that they would lead to, significant increases in inflation, targeted to durable goods and, imported goods. Obviously not, we're a services-based economy, not really going to have too much effect there. But I think at best it was, you don't want to bring up the T word, the transitory word again, but I think that was like the best case scenario that you would have. And this was even the Federal Reserve's
these are
projections that there would
the
be,
best minds on Wall Street, the
a
best economists.
couple quarters worth of increased inflation, which would then temper down. And we didn't even really get that. I mean, now you don't know to what extent inflation would have fallen further, right? I mean, could we have been at 2% by now absent tariffs? Maybe, right? So did it keep it higher than it would have been otherwise possible? But it didn't really lead to an increase.
It absolutely didn't, and certainly the narrative back in April, and then the market did come down almost 20% from peak
Hmm.
there at the very beginning of April, when the president announced his tariff policy. People were afraid. The market crashed in just 2 weeks. It was enormous. People were very frightened, and no one was saying that inflation was going to stabilize. That I heard of. All the talking heads were saying inflation is going to spike, and it was going to be tremendously difficult for the U.S. economy. Which has come back to a point that we hold here, tried and true, Zach, on the podcast. If ever you have an instance where people are all saying the same thing, you got to poke your head up and say, wait, maybe that's not going to be happening because that is priced into
Yep.
the market. And here we have, it's not like some, wonky professor in some small liberal arts school. This is like the Federal Reserve Bank of San Francisco, not the most conservative of the banks. So I thought that was really interesting. So inflation is inflation has worked out much better than expected. One reason to be positive here.
We
I
did a
see a
live
slide here on
the
tariff,
first
Zach.
the first live pop in of the year.
Love it. Real time.
Just since we were talking about it, I had this chart off to the side, but you know, it's bringing in revenue. I mean, 30 plus $billion a month right now is coming into the treasury. Now, as a percentage of the budget on the right hand side, right? Like not it's still a pretty small amount, but that's real money that you would not have otherwise in the coffers of the treasury. And at least so far, it's really being borne by the importers. It's not really being passed along to consumers. And I think you can go through and say, okay, well, what would profit margins be otherwise? What would cost be otherwise, right? But it's not leading to that disastrous inflation reigniting, that I think folks were concerned about.
I there's so many variables. We're not saying we have a grip on all of them. All we're saying is that there is a lot of talking heads out there that are on one side of the equation. And when that happens, it's always a good idea to question them significantly. So good to see. I don't think anyone was expecting that. So tariffs have worked out better than expected. Inflation has gone better than expected. And then one of the most primary driving factors, Zach, you know, and everyone at home hopefully knows this by now. One of the three primary drivers, I believe, of stock growth are earnings. Are companies profitable and are they increasing their profitability? So 2025 actually turned out to be an exceptional year. And I have a data point here on the screen. 82% of S&P 500 companies outperformed earnings estimates in the fourth quarter with an average of 13%. That was double what was expected 12 months ago. And it was the best performance in since Q3 2021. And it might end up supporting these lofty stock market valuations. More on that in just a moment. Going forward to 2026, and I saw this in the journal as well. Predicted growth of 15%, which could be higher, could be lower in 2026. If that happens, that would be the best in 5 years, Zach. So I think
Yeah.
there's reasons to maybe support these valuations here
Yeah,
going
and we,
forward.
we talked about this, I think, several times through, 2024, late 24 and into early 2025 that, the easy comps coming off the bear market, we're done. And then, corporate earnings, we're going to have to clear really high bars moving into, later half of 2025 and into 26. And they're clearing them by a lot, right? I mean, they're over indexing on the expectations, which again is just it's just kind of proving that this market and the corporations that make up the index are really strong right now.
Very strong. And I think taking a step back, if we went back 12 months ago and told you inflation was going to come in much better than expected and corporate profits were going to come in much higher, much better than expected, I mean, you would be much more optimistic than I think most folks were on the street, although they were relatively optimistic. So, corporate profits, inflation. The third thing I want to mention is just momentum. No one can really explain why momentum is so important. It's not something you can put on a chalkboard with a bunch of variables. But I wanted to highlight that once momentum is in the marketplace, it tends to
Hmm.
stay. And so a couple charts here quickly. I think this came from our friend Carson. This is talking about a slingshot. And that means that at some point the year the market was down 15% year to date. That happened last year and ended up double digits. It doesn't happen very often. In fact, it's only happened 3 times in the last 75 years. Very small sample size, but when it does happen, which is an indication of momentum, the market was positive a year later with an average return of 19%. So just a real quick, simple one. But I also want to highlight something we've talked about many times here. And I think this is a fundamental principle in what I believe is going to happen going forward. This is just talking about when the Federal Reserve Bank lowers interest rates when the stock market is within 2% of an all-time high. So the market doing well, and the Federal Reserve is reducing rates, which is thought to improve the economy or make economic conditions better. So when this happens, there have been 20 previous times since 1980 in the last 45 years. Every single time, markets higher. And this happened in August for the first time, but it also happened, maybe, sorry, September, but it also happened in November and December. So there are 3 times that happened recently. Average market return over that time, 14%, median 10%. So I think that's a lot of momentum going into the market. We've talked about it a long time. Anything you want to add to that, Zach?
Yeah, I mean they're cutting into strength, and the only real risk of that is reigniting inflation. I think absent inflationary increase is that conditions will be easier, right? I mean, lower interest rates are good for lending. They're good for investment, building businesses. They're good for the long-term cash flows of a lot of these tech companies that are discounted back at a lower rate. So if you don't have inflation as a result of the lower rates, then there's really not much risk of them lowering them. So cutting into strength and with inflation still pretty tepid. It seems to be that it's going to follow this pattern.
And there's a lot of news in we should, I think this month, right, Zach? The President Trump will announce his new Treasury
Yeah, probably any day.
any day. So that's going to be a big market moving consideration. And the president is getting a lot of friction because he wants lower rates. And that's been a politicized issue, I believe. I mean, if you look at the ECB, the European Central Bank, as well as the Bank of Canada, they both have, correct me if I'm wrong, Zach, interest rates that are at least 1% lower
Hmm.
than the United States does at the moment. So there could be more cuts coming into
And
next year,
one
maybe.
one thing to keep an eye on though is that, you know, the Federal Reserve only controls one interest rate, right? The overnight rate, the very short end of the curve. The market controls the rest of the rates. And what we've seen really over the last 3 months is like as they're cutting those short-term rates, the 10 year is not really moving. And it's actually going up a little bit. So I think the market is saying, the market could say, really, regardless of what the Fed does, the market could kind of do the Fed's tightening job for them and just keep interest rates stable where they are and say, we're not, the 10 year is not going to come down to, three and a quarter again, three and a half.
The
I
most
think it was 4.2% today, 4.18 or something like that.
Yeah. The most important thing for folks at home is your money market rates will probably go down in 2026 by
Yeah,
0.25 to 0.75%.
correct.
Um, will
Yeah,
mortgage
10
rates come
years,
down? Time will tell.
10 years, 4.18 right now. So,
Nailed it.
not really following along with what the Fed's doing over the last 3 months. It's like exactly stable. So 3 months ago it was 4.16 on October. We've had two cuts since then.
We're sorry to harp
Um,
on about interest rates, but they are an integral part of the market metrics here, and they drive a lot of the underlying returns.
yeah, and I
Um,
think a good take home for that is that no matter how much you hear about the Federal Reserve and the chairman and what Trump wants with interest rates and all of that, ultimately the market determines most interest rates in the economy. And so there's not as much control over it as I think people might have the sense of.
Agreed. Sorry, folks, Federal Reserve talk. We get into the weeds. We love it. We love it, so you don't have to. Okay, so three reasons why I think markets can go up. I want to share, listen, a few reasons why things look choppy here. We're in the fourth year of a bull market. We had three double-digit years in a row. So what could happen going forward? I think one of the primary concerns, and this is what Jack, you and I have talked about this a lot, but this chart here I pulled from JP Morgan. It's just talking about market valuations. Is the market expensive? Is it cheap? The higher this ratio, the less cheap it is, the more expensive it is. And you can see here the price earnings ratio this month is at 22x compared to a 30-year average of 17, implying that things are pricey. Now, I just highlight this in passing because it is a one indicator of medium to longer term returns, but not really that great for short term in the next 1 to 2 years, let's say. Not a great indicator, just something to keep our eyes on. The second thing I want to mention is seasonality. We're coming up on a midterm election. I'm sorry to talk about politics again so soon. Please don't click off the channel. But I just want to highlight one thing, just from an investment standpoint. Mid-year elections tend to be a terrible year for the S&P 500 index. So over the last 75 years, it finishes up only about half of the time compared to about 80% of the time for the other 3 years. Average during that time, Zach, 4.6%. So this is seasonality. This is typically the weakest of the four electoral years when we're coming into a midterm election. So just something to be aware of. And the second point I want to mention about seasonality is we're in the fourth year of a bull market. That can be pretty tough. There only have been 10 other times the markets were up 10% or more 3 years in a row. So it's not a very common occurrence. And the fourth year averages only 4.6% of those previous 10 occurrences, and half of those were down. So, those are some considerations that I'm watching. Seasonality is a big one. And then I guess the third point I mentioned, listen, there's many things going on in the economy. I only want to highlight a couple of them, but is the labor market softening? And you have a chart here from the Labor Department, and it's showing you non-farm payrolls have seemed to be on a decline here, even a couple losing months. Now, there's just tremendous distortion here, but it's hard to deny the trend. Zach, any thoughts?
I mean, look, immigration is decidedly negative, right? I mean, I don't think there's any argument about that. More people leaving the country than coming into it, which has a significant impact on these numbers. So I think our natural economy, absent people coming into it, just doesn't create all that many jobs. It's a mature economy, and I think a baseline number lower than what we're kind of used to is normal. So it's hard to tell, with those distortions you mentioned, right? I mean,
That's the one
because of
distortion I'm thinking of.
immigration
The
trends.
second
Yeah.
one, of course, is the government, federal government uh, lightened their
Right.
workforce through the Doge efforts. So there's a lot of distortion here. A lot is going into. We're going to have a jobs number, I think, this Friday, so just in a couple of days. Um, I don't think it's a big deal. I think there's still 7+ million jobs open in the country, which is pretty much on track. So I just mentioned this in passing. It's a trend, and when there's a trend, we want to watch it. So without any other ado, what's Brent's best guess for 2026? And I'll say this with a abundance of caution. There's no returns, no guarantees. But I want to start by just giving you two of my favorite prognosticators. The first is Brian Westbury. Do you follow him, Zach?
Yeah, of course.
Had the opportunity to see him out here in California speak live, and he's just so charismatic. He spoke to Congress a couple
Yeah.
of days after, but he is one of year after year one of the top two or three most accurate economists with his guesswork. So that's why I follow him, and he's a really smart guy. So he says in his 2026 expectations, quote, "We can't summon a path for growth in 2026." He's talking about the S&P 500. So he kind of goes through these hoops and says, like, with jobs are this, and the economy is that, and growth is this. He goes, no matter what, we just can't foresee growth in 2026. Okay, smart guy. Ryan Dietrich, former LPL strategist, now at Carson Wealth, probably my favorite guy. He's a cheeky kind of happy guy. Listen, they expect 10% growth or more in 2026. So all that to say, very smart people, all over the place. My best guess, I think there's an 85% chance we have a positive year, better than zero. I think there's a 70% chance we do better than 10% total return. This is predicated on three primary factors. And I don't know, of course, but I think that with the Federal Reserve lowering interest rates, easing economic concerns, going into a growth market within 2% of all-time highs, I think it's a very strong indicator of momentum. But Zach, I don't know if you saw this. I saw this in the journal over the weekend. It really surprised me. Investors pulled $353 billion from stock funds in 2025. I would have assumed they added money to 2025, wouldn't you?
Yeah. Yeah.
Um,
Yeah. It's it. Yeah. And there's that K-shaped sentiment, right? Where there's stock market sentiment and there's consumer sentiment, right? And the stock market sentiment's pretty positive. The consumer sentiment is as low as it's ever been. So
hmm.
it's really interesting to see the difference.
And so 353 billion coming out of stocks, over 600 billion going into bonds. And the second point there, Zach, you just said it. Consumer sentiment right now, according to the University of Michigan Consumer Sentiment Poll, is lower than at any point during the great financial crisis, when the unemployment rate was at 10%, when the economy was on the ropes. People are more pessimistic now, and I think there's a lot of reasons to go into that, or that go into that. But if you also look at, just to push back, Zach, if you look like the CNN Fear Greed Index, I think investors are also spent most of the year very pessimistic as well. All that to say is I'm a contrarian at heart, and I think that these people pulling money out of stocks, people are very pessimistic. I think these are counter indicators that could incite things to do very well in 2026. So my best guess is that we have a pretty good year going forward, and we'll
Yeah,
see you in 12 months.
yeah. And Westbury's targets 6,000, which is about 17-18% lower than it is today.
Yeah.
And he
So
has this thing. He has this thing, a profits model, where they take interest rates and take earnings and put it into an equation and spit out a number. Um, but yeah, I mean, I think his target in 2025 was 5,700 maybe or something like that. So obviously
yep,
undershot
yep. Well,
the year there.
we'll see what happens. These are both. Listen, the point is, like, you have 21 Wall Street banks saying one thing.
Yeah,
You've got Brian Westbury saying another. It's a complicated thing. Invest for
yeah,
the long term and diversify as always. Zach, I turn it over to you.
for sure. So I think one of the biggest, risks in the market is that K-shaped economy that we talked about, and that the top cohorts of wealth and income are really driving consumer spending, which in turn really drives our domestic U.S. economy. We are a consumer-driven economy. 70+% of our GDP is consumer spending, and so I think a risk to the downside is if we do have a stock market event. I think in April of 2025, it was so quick and it rebounds so quickly that there wasn't time for folks to adjust their spending habits. But if we do get some sort of somewhat prolonged bear market, the wealth effect from those top income and wealth cohorts, I think could have a an outsized effect on the economy at large. So that's when you have a top heavy market, it can withstand things that you would think maybe it wouldn't otherwise, like in persistently high inflation, because the reality is even at 3% plus inflation, the folks at the top 20% of incomes are it's annoying to them, but it's not really going to change their habits or change their spending. Um, but that can cut both ways when those folks, a lot of their wealth and income is tied into the stock market, and a decline there could have an unbalanced effect overall. So something to keep in mind that we are a top heavy economy, and um, that can go both ways. I thought this was
Absolutely.
interesting on the next slide. The the pushing forward your midterm slide, right? Your midterm years. This is looking at in midterm years does tend to have larger intra-year declines, right? They have larger corrections and they bottom later in the year. So if you go through that list, you see a bunch of Octobers and Novembers and Septembers and Augusts, right? But if you push that out a year forward from those troughs, you actually get really, really strong rebounds after the midterms, going into that third year. So I just thought it was a kind of interesting dynamic where you see generally under average performance in midterm years, but then followed typically by a pretty sharp rebound. And there's data going back to 1950 here, so it's pretty good number.
That's a great
33
chart. Thank you,
thirty-three
our friends at
percent.
Carson Wealth.
Yep, Carson Wealth. There he is, Brian Dietrich. Um, so thought that was interesting, and and trying to time when that correction is going to happen. I mean, that's
Yeah,
that's an
all to say,
impossibility.
like, if you don't need your money in the next, 18 months, it's maybe prudent to
Exactly.
not try to time the market, which is always a sticky
Exactly.
wicket.
And look, and the flip side of that is if you do have, and I talk with clients all the time about this, that if there are expenses coming up, in summertime, you're going to redo something with the house, or you're going to take that big trip, or college tuition is going to start next September or something like that. Well, then let's maybe let's look at the portfolio today and perhaps start to plan an earmark for that now. Um, if you do have that liquidity need in the next 12 months, right? If you're a long-term investor, your time horizons push beyond that. Not necessarily important, but it depends on your specific circumstances as investors, and talk to your trusty financial advisor for uh, advice there.
Exactly. Good chart.
Um, and going back to kind of valuations, the what I thought was really interesting, if you look at tech, which is what everyone talks about, with tech having the loftiest of the valuations, and in 2025, the tech valuations actually fell by 9%. Their earnings growth was 34%, uh, and leading to a price increase of 23. But the multiple actually contracted quite a bit. So I thought that was really interesting. It's not a situation where we saw in the end of the 1990s where just valuations just explode, outpacing earnings growth, paying more and more and more for every dollar of earnings, no matter what. It's actually really the opposite situation in those big tech names. The earnings growth are outpacing the multiple growth, at least in 2025. And if you go down to the S&P 500, a very balanced year. Um, Multiples only expanded 2.5% across the board, while earnings grew nearly 14%. So that was a really important metric to look at. That going back to Jan 1, 2025, even though the market's 17% higher, the valuation's not, right. It's marginally higher.
Yeah. So can
So
you say it
some
again, Zach? So the market is up, 16.6 or so percent. But in terms of, when you subtract out the earnings growth that happened, we talked about earlier, is net of net up like 2.5%.
yeah,
Yeah.
yeah, multiples really didn't expand all that much.
Yeah.
Uh, and so that's, I think, just something you can point to and say, okay, well, this was an earnings driven rally in 2025. It was not a speculative rally. It wasn't a bubble rally. People weren't just paying any price for anything. No, these companies delivered and exceeded expectations on their earnings, and that's why the market was up in 2025.
Yep. Great chart.
And then we looked at this before, but I just love this chart. I love this concept of adjusted price to earnings ratios based off of the profitability of the companies. And this is from Duality Research. It's a Substack out there. They put out really good stuff. But they take the forward profit margins and adjust the forward price to earnings ratio based upon that. And instead of just having a static view where you're comparing 30 years ago to today and saying like that JP Morgan chart where it's like, hey, price earnings of 22, this is what it was in the year 2000. Looks, you can compare those two things. I would argue, as Duality Research argues, that you can't really compare those things in a
Mhm.
vacuum without adjusting for the fact that for
Yeah,
every
the
dollar of
constituents of the S&P 500 index are much different than they were 10, 20 years ago. And that's a
much
great chart. And that would
much
mean,
more
Zach, that
profitable.
we're less frothy, right?
Yes, much more profitable for every dollar of revenue that comes in. S&P 500 profit margins are near 17%. Back in 2005, they were half of that. They were 10%, a little less than half of that. And so it doesn't necessarily make sense to compare those two things without adjusting for that. And so if you do adjust for that, that top panel is the adjusted PE ratio, and you can see in the background the kind of shaded is like the actual one. You can see
The
22,
standard
right,
S&P
where that
500.
ends up. But the green line is adjusting for those profit margin changes, and it actually puts the PE at 16.7, which is really basically average. So if you account for that, it may not seem as expensive as you think, judging based upon where profit margins are.
Yeah,
So I think this is really important and interesting.
you hear people out there talking about how we're at the highest price to earnings ratio since, or the highest CAPE ratio and
Yeah,
cyclically adjusted price to earnings ratio from Robert Shiller. He's a Nobel Prize winning economist, but they're all, out there screaming, worst ever since the tech bubble. But
yeah,
those companies weren't profitable. These companies, as this chart indicates, are exceptionally profitable, the most profitable in history.
yeah.
So it's a great reminder.
Yeah, absolutely. And then I always love looking at kind of what insiders are doing. It doesn't always give you the best indication because there's reasons why insiders sell and buy all the time that are outside of what they think of the prospects for the company. But if you can, if you look on a broad basis and you say, okay, on an aggregate, what are insiders doing? Are they buying? Are they selling? They obviously have information, um, and insiders are buying hand
Love
over
that.
fist right now in the Nasdaq 100. This is the Nasdaq 100, um, and they're buying heavily. Going back, you can look at some different periods. They were heavily buying in 2022 when the markets were down, right? Heavily buying during COVID. And you can see some other periods of heavy buying internally. And they tend to persist. We're kind of at the beginning of this. It was fairly muted throughout the first half of 2025 and kind of really accelerated toward the end. Has a really significant track record of win rate in the Nasdaq
So yeah,
of when
break
these
that down
insiders
for
are
us if you
buying.
don't mind. 12
Yeah,
months
sure. So
forward.
yeah, yeah. So the top there is just an indicator of kind of net buying and net selling. Um, Above that green line is periods of significant insider buying, and then at the bottom it's looking at those dots when it's above data points that are significantly above that green line performance 1 or 2 weeks later, 1 month, 3 months, 6 months, and 1 year. And the green, obviously 1 year later, average returns 33% when you get these significant insider buying events. So
Is
again,
that
one
your
data
official
point.
2026 estimate, Zach?
Yeah, maybe not. Um, but I think looking at what these folks are doing and um, having a lot of confidence, in the companies that they're working for. I think does speak to something and something important to note.
Yeah, really great.
Um, you know, international. If we're going to go to the next one, international markets did outperform the U.S. this year. Um, but I thought this was really interesting. This is a snapshot of Alphabet, which is Google's parent company's um, balance sheet for the year end of 2025. They put a new line in there, which is accrued European Commission fines.
Wow.
It's now a
The
standard
price of doing
line.
business, a new tax.
It's now a standard line in their balance sheet. And it just, the US is still the best place to invest,
Was that
despite,
$6.3 billion in fines
yes.
for making
And
the
that was
internet
that
safer?
was as of
And
December 31st, 2024. They added another 4.2 billion just in the 9 months ending in September.
unbelievable.
Now these are accrued, so they're fighting them, right? They're in court, so they're just there. They're haven't paid them out yet, but they're a liability on their balance sheet of $10.5
The
billion, and
world we live in.
it's just a cost of doing business in the European Commission. Um, and so I just still view as despite our dysfunction, that the U.S. is still by far the most um, the best place to invest your capital.
Or start a company.
Um, one little thing to a couple of little things to watch I think are important. Um, we talk a lot about the AI capital expenditure funding being largely driven through cash flow. So, Google and Meta and all these companies just make boatloads of cash and they're investing in data centers, right? They're not taking on massive debt. Their balance sheets are still pristine. One thing to note though is that there are some companies out there, Oracle being the biggest one, Meta then XAI, that are moving this debt off their balance sheets through these things called special purpose vehicles. So they're essentially working with Wall Street, banks and investment companies to create investment funds, debt funds that can then fund their data center build outs. And by doing it that way, they're keeping it off of their balance sheets. So that $66 billion that Oracle has in debt doesn't show up on their balance sheet.
Hmm.
It's through this special purpose vehicle. So it's something. Look, this is a small piece of the
Canary in the coal
overall
mine,
investment.
maybe.
It's a potential canary. It's something to definitely keep an eye on. It's a complex financial maneuver to make things look less indebted than they are. And unless you kind of really dig into it, you might just look at their balance sheet and say, "Oh, hey, look great. They're not taking on any debt to do this," without actually seeing it off to the side. So if this continues to grow, you start to see more and more companies do this. It's definitely something to keep an eye of that there could be, more risk on a leverage basis when it comes to building out all these data centers. Um, and then just want to end on the next generation. I think that we've seen a significant decline in household formation, demographics. I think I've talked about demographics, 100 times, and I still think that's the biggest story of the 21st century. Um, and so if I think young folks out there are struggling a little more than some prior generations. Less than 30% own a home at 30 years old. 20% are married, right? A lot of them don't live on their own. So I think something important to note and to watch is the success of the next generation. And I think it's incumbent, I think, on all of us to um, bring those folks along, whether it's through employment or mentorship or folks in your own family or whatever it is, right? We don't want to see that gap widen too much more. I think that could lead to significant. We've already seen it lead to political instability, but you don't want it to lead to further civil and economic instability.
Yeah. Yeah. Dislocation between the generations in terms of financial well-being for sure. Well, Zach, thank you for the wonderful insight there, my friend. And for all you folks at home, we're looking forward to seeing you again in the near future. If you have any questions, as always, please reach out to us and we'll talk to you next time on Finance Footnotes.